The following content is provided under a Creative Commons license. Your support will help MIT OpenCourseware continue to offer high-quality educational resources for free. To make a donation or view additional materials from hundreds of MIT courses, visit MIT OpenCourseware at ocw.mit.edu.
Our last class, Yi is running from his home in New Jersey due to snow, so he couldn't fly in. But actually, it's now I'm learning a lot. It's a good way to run the classes going forward. I think we may employ it next year. So he will present CVA modeling for about an hour, and then Jake, Peter, and myself will do concluding remarks, and we will be happy to answer any questions on the projects or any questions whatsoever. All right? So Yi, please, thank you.
Okay. Yeah, thank you. Hi, everyone. Sorry I couldn't make it in person because of snow. But I'm happy, right, to be able to have this opportunity to discuss with you guys counterparty credit risk as a part of enterprise level derivatives modeling. I run a cross-asset modeling group at Morgan Stanley, and hopefully you'll see why it is called cross-asset modeling soon. Okay, counterparty credit risk exists mainly in OTC derivatives. When you have an OTC derivative trade, sometimes you owe your counterparty money, sometimes your counterparty owes you money, right? If your counterparty owes you money, on the payment date, your counterparty may actually default, and therefore it will not pay you the full amount it owes you. Okay, the default event includes bankruptcy, failure to pay, and a few other events. So obviously, we have a default risk. If our counterparty defaults, we would lose part of our receivable. Okay. However, the question is, before the counterparty defaults, do we have any other risks? Imagine you have a case where your counterparty will pay you in 10 years. Okay, so it doesn't need to pay you anything. Okay, then the question is, are you concerned about counterparty risk or not? Well, the question is yes. As many of you probably know, it's the market risk due to the likelihood of a counterparty future default. Okay, it is like the counterparty spread widening. Even though you do not need payment from your counterparty, if you were to sell, your derivative trade to someone, and someone may actually worry about that. Okay, so therefore the market will become lower if the counterparty spread widens. Okay. This is similar to a corporate bond, in terms of economics, right? You own a bond, okay, on the coupon payment date or on, principal date, the counterparty can default. Of course, they can default in between also. But in terms of terminology, this is not called counterparty risk. This is called issuer risk. So here comes an important concept, credit valuation adjustment. As we know, the counterparty credit risk is a risk. Okay, whenever there's a risk, we could put a price on that risk. Credit valuation adjustment, CVA, essentially is the price of a counterparty credit risk. Okay, many mark-to-market risks, of course, include, default risk too, right? It is an adjustment to the price or mark-to-market from a counterparty default-free model or broker quote. Okay, so people know, right? There's a broker quote. The broker doesn't know, the counterparty risk. And a lot of our trade models does not know the counterparty risk either, mainly because of the, portfolio effect, which I will talk about in a minute. So therefore, there is a need to actually have a separate price of CVA to be added to the price or mark-to-market from counterparty default-free model to get a true economic price. Okay. In contrast, in terms of a bond, typically there's no need, for CVA because it is priced in the market already. Okay. And CVA not only has important mark-to-market implications, it is also a part of Basel III credit capital. Okay, not only change your valuation, but could impact your return on capital because of a CVA risk. The capital requirement typically is higher. Okay, so you may have a bigger denominator in this return, ROE, return on capital, or return on equity, right? CVA risk, as you may know, has been a very, important risk, especially since the crisis of 2008. Okay, during the crisis, a significant financial loss actually is coming from CVA loss, meaning mark-to-market loss due to counterparty's future default. And this loss turned out to be actually higher than the actual default loss and than the actual counterparty default. Again, come back to our question, right? How do we, think in terms of pricing a derivative and price the CVA, together with the derivatives? Okay. First of all, it has some, portfolio effect, right? The counterparty can trade multiple trades, and the default loss or default risk can be different depending on the portfolio. And when people use a trade level derivative model, which is, by default, what people call a derivative model. Typically, you price each trade, price one trade at a time, and then you aggregate, the mark-to-market, right, together to get a portfolio, valuation. So when you price one trade, you do not need to know there may be another trade facing the same counterparty. But for CVA or counterparty risk, this is not true. Okay, we will go over some examples soon. And this is one application of what I call enterprise level derivative, essentially focusing on modeling nonlinear effects, nonlinear risks in a derivatives portfolio. Here is a concrete example. Hopefully, can help you guys to gain some intuition on the counterparty risk and CVA. Okay. Suppose you have an OTC derivatives trade. For instance, like IR swap. It could be a portfolio of trades. Okay. And let's make it simple. Let's assume the trade PV was 0 on day 1. Okay. Of course, we assume, we don't know anything about counterparty credit risk. We don't know anything about CVA. This is just to show how CVA become, recognized, by people, right? So to start with, again, the trade PV was 0 on day 1, which is true for a lot of swap trades. And then the trade PV became $100 million later on. Okay, and then your counterparty defaults. Okay, with 50% recovery, and you get paid, $50 million of cash. Okay, so 100 million times 50% recovery, right? If counterparty doesn't default, you eventually would get $100 million. Now it defaults, you get half of it, $50 million. The question is, have you made $50 million or have you lost $50 million? over the life of the trade? Anyone has any ideas? Can people raise your hand if you think you have made $50 million? Can I see the people in the class? I couldn't see anyone.
No one raised the...
Okay, no one think made the $50 million. Okay, so I guess then, do you all think you have lost $50 million? Can people raise your hand if you think you have lost $50 million? Okay, and I see some people did not raise your hand. That means you are thinking you are flat, or maybe you want to save your opinion later. Okay, so this is a common question I normally ask in my presentation, and I typically get two answers. Some people think some people think they've made $50 million. Some people think they have lost $50 million. And there was one case. Someone said, okay, they are flat. Now, this looks like a new interesting situation where no one thinks you made $50 million. I mean, come on, you have $50 million of cash, in the door, and you don't think you have made $50 million. You have zero from day one. Now you have $50 million. Okay? All right. Anyway, so for those who think you have lost money, I don't know if it's a good idea, right? I mean, can someone tell us, why do you think you lost $50 million? You went from zero to positive $50 million. Why do you think you lost $50 million? Are we equipped to allow people to answer questions?
Yeah, I think if somebody presses a button in front of them.
Okay, so people choose not to voice your opinion.
Is it because you have to pay, it's a swap and you have to pay $100 million to someone on the other side of the trade?
Okay, very good. So essentially you are saying hedging. Is that what you are trying to get to? So you have a swap, zero, and you have offsetting swap as a hedge. Is that what you are trying to say?
No, I'm saying that if you're the intermediary for a swap, then you have to pay $100 million on the other end. So if you're receiving 50 and paying 100, you have a loss.
That's good, right? So intermediate, right? I mean, that's similar to a hedge situation, also, right? So that's correct. That's basically the reason, right? For a dealer, right? Essentially, we are required to hedge with very tight delta limit, right? We actually would lose $50 million, mainly on the hedge side. Okay, when our trade went from zero to a positive $100 million, our hedge would have gone from zero to negative, $100 million. The fact we receive only half, of what we are, what we need to receive, and yet we have to pay, the full amount that we need to pay on the hedge side. Essentially, we lost $50 million. Okay, but that's where the CVA, and the CVA trading, CVA risk management would come in. Again, CVA is a price of a counterparty credit risk, right? And if you hedge, right, the underlying trader, whoever trades swap, if you hedge with the CVA desk, right, theoretically, right, you will be made whole, upon counterparty default. So you would receive $50 million from counterparty, and theoretically you would receive $50 million from the CVA desk if you hedge with CVA desk. Okay. Now, second part of the CVA, is how do we quantify CVA? How much is the CVA, right? CVA on the receivable, which we typically charge to the counterparty, essentially is given by this formula, right? MPE means mean positive exposure, meaning only our receivable side when the counterparty owes us money, and times the counterparty CVS par spread. Okay, times duration. Okay, the wider the spread, the more likely the counterparty, will default. The more we need to charge the CVA. And the same thing is true for the duration. The longer the duration of the trade is, there's more, time for the counterparty to default. So we need to charge more. I mean, very importantly, there's a negative sign because the CVA, on the receivable side is our liability, and it's what we need to charge our counterparty. And there are some theoretical articles, they don't include the sign. That's okay for theoretical purposes, but practically, if you miss this sign, things are very confusing. Okay, now here's more accurate formula for CVA, on the NPE side, meaning on the asset side, right? So we can see, right, to start with, there's an indicator function where this capital T is the final maturity of the trade or counterparty portfolio. And this tau is the counterparty's default time, first default time, okay? And if the tau is greater than, this capital T, essentially that means the default happens after the counterparty portfolio matures. And therefore we do not have counterparty risk. So that's what the indicator is about. And if the counterparty defaults before the maturity, that's when we will have counterparty credit risk. And there's a future valuation of the counterparty portfolio right before the counterparty defaults. And this is how much collateral we hold against this portfolio. So the net, receivable, the net amount where this future value is greater than the collateral, right, is our sort of exposure, okay? How much the counterparty would owe us, right? And this, 1 minus R essentially is the recovery. So 1 minus R times, exposure essentially is the future loss given default. And this beta essentially is the normal money market account for discounting. And this is the expectation and the risk neutral measure. Okay, it looks simple, but if you get to the details, it's actually fairly complex. Mainly because the portfolio effect and this option-like payoff. If you recognize this positive sign here, essentially you recognize this is like option, right? And so again, here's about some details of nonlinear portfolio effects. Okay, first of all, we talk about offsetting trades. In the previous example, right? You have one trade, right? Went from 0 to 100 million. Counterparty defaults, you get paid 50 million. Essentially, you lost 50 million, right? But what if you have another trade facing the same counterparty, but that's offsetting, right? When the first trade went from 0 to 100 million, the offsetting trade can go from 0 to negative 100 million. And therefore, if the counterparty were to default, you're going to have a 0 default loss. That's just one example of portfolio effect because of offsetting trades. So therefore, in order to price CVA, you got to know all the trades you have facing the same counterparty. This is very different from a trade level model where you only need to know one trade at a time. Okay, there's also asymmetry of handling of a receivable, meaning assets, versus a payable, meaning liabilities. Okay, and that's where the option-like payoff it comes about. Okay, so typically, roughly speaking, right, if we have a receivable from our counterparty, if counterparty were to default, we're going to receive a fraction of it. So we would incur default loss. However, if we have a payable to our counterparty, and if the counterparty were to default, we more or less need to pay the full amount. So we don't have a default gain per se. So this asymmetry is the reason for this option-like payoff we just saw previously, right? And as you know, a counterparty, right, can trade many derivative instruments across many assets, such as interest rate, FX, credit, equity, and a lot of times also commodities, and sometimes also mortgage. Okay, and my group is responsible for the modeling of the underlying exposure, for CVA, for capital, as well as for liquidity, because of multiple assets are involved, and we need to model cross-asset. So therefore, we named our group cross-asset modeling. Furthermore, it is not only we have option-like payoff, which is nonlinear, we have an option essentially on a basket of a cross-asset derivative trades. And the modeling becomes even more difficult. So that's, when the enterprise level, will come in. And the enterprise level model, which we'll touch upon a little bit more later on, we'll need to leverage trade-level derivatives models. And therefore, we'll need to do a lot of Martingale-related stuff. Martingale testing, resampling, interpolation, right? So here's a little bit more information on the CVA. We have talked about asset or NPE CVA, essentially for our asset or receivable. Okay, this formula we have discussed already, the first one. There is also theoretically a liability CVA. Okay, essentially is the CVA on the payable side when the bank or when us having a likelihood of default. Okay, and this is a benefit for us, right? So the formula is fairly symmetric, right, as you can recognize, except the default time or default event is not for the counterparty, but for us. Okay, and then the positive sign here became a negative sign, essentially to indicate this is payable, right? Negative liability to us, right? I mean, this is an interesting discussion. First, default. Okay, we talked about if the counterparty were to default, right, we more or less need to pay the counterparty full amount. Okay, so this argument can be used on the receivable side. So if we have a receivable, and if we were to default first, roughly speaking, the counterparty would pay us close to the full amount, right? And there's some people start to think about, okay, when we price CVA, we got to know among counterparty and itself which one is first to default. But my argument is that we do not need to consider that, right? And I have some reference for you guys to take a look if you are interested in this problem. But I'm not going to spend much time because we have a lot to go over. Okay. Now here's another example. You have a trade, same as the previous trade. Okay. The trade PV was 0 on day 1, and the trade PV becomes $100 million later on. This time, of course, the counterparty risks are properly hedged. Okay. Then the question is, do you have any other risks? Does anyone want to try to tell us, do you see any other risks? there are actually, several categories of risk we will have. I wonder if anyone would like to try to share with us your opinion. Sorry, I couldn't hear you. Yes?
Some form of interest rate risk.
Interest rate risk. Okay, fine. This is market risk. Yes, you're right. I mean, there is interest rate risk. But I did mention here, the market risks are properly hedged. So that means this interest rate risk of this trade can be canceled by the hedge. What are the risks?
Is there a key man risk? So if the trader that made the trade leaves and doesn't know, what's
okay.
the portfolio?
That's a good point. Yeah, there is a risk like that. Yeah. Any other risks? Okay. Okay, let's go over this then. I claim there is a cash flow liquidity funding risk. Okay. Our trade is not collateralized. And then I claim we need funding for uncollateralized derivative receivables. Meaning we are about to receive $100 million, in the future. We don't have it now. And I claim we actually need to come up with cash for it. In many cases, in most cases, not every case. Anyone has any idea why, when you're about to receive money, you actually need to come up with money? This comes back to the hedging argument, similar to CVA, right? Essentially, if you were to hedge your trade with futures or with another dealer, which are typically collateralized, that means when you are about to receive $100 million, essentially you are about to pay $100 million on your hedge. The fact, right, if you hedge with futures, the daily mark-to-market, that means you need to actually really come up with $100 million cash. The same is true for collateralized trade. And that's where, the risk is. Because when you need to come up with this money and you don't have it, what are you going to do, right? You may, end up like Lehman. And there's also contingent funding liquidity risk, meaning how much liquidity risk is dependent on the market condition. Okay, how much interest rate change, how much other, market risk factor changes like equity. And depending on the market condition, liquidity risk can be different, and you may not know beforehand. So that's the another challenge. What's interesting is that if you turn the argument around, applying the argument to the payable, and if you have uncollateralized payable, essentially you would have a funding or liquidity benefit. So one interesting thing to manage this liquidity risk essentially is to use uncollateralized payable funding benefit, right, to partially hedge the funding risk in uncollateralized derivative receivables. There are a lot of other risks. For instance, tail risk, and equity capital risks. Right. Now here's one more example I'd like to go over with you guys on the application of CVA. Okay, this is about setting put options or put spreads. Right. If you trade stocks yourself, you may have thought about this problem. Right? I mean, either you can buy the stock outright, or you can sell put. Okay, possibly with strike lower than the current price. Right? And with that, you more or less have like a similar payoff. Right? Some people may argue, okay, if you sell put, if the stock comes down, you're gonna lose money, right? but you're going to lose money if you were to hold the stock outright also, right? One of the disadvantages is that if you sell put, right, if the stock is not put to you and you're not participating in the upside, when the stock price increase, significantly, right, then you're not going to capture that upside, right? But of course, one thing people can do is you continue to sell put, right? So it becomes like an income trade, right? So it's an interesting strategy. Some people say selling put is like name your own price and get paid for trying it. And that's why we have this famous trade. Warren Buffett, Berkshire, sold long-dated puts on 4 leading stock indices in US, UK, Europe, and Japan. Collected about $4 billion premium without posting collateral. Okay, without posting collateral, that was very important, right? This is something I actually was fairly involved in one of my previous jobs. This happened about, I think, around 2005, 2006. Okay, it's one of the biggest trades. Okay, and I was told, right, when I was involved in this was like one of the biggest cash outflow in the derivative trades at that time, right? Because Warren Buffett collected the premium without posting collateral, right? If he had agreed to post collateral right during the crisis, 2008, he's going to post many billions of dollars of collateral. I guess one reason he had more cash than other people was he's very careful, right? And I think I have a reference. If you are interested, then you can essentially see this link. Right? And the stock industry and what's interesting is that there were quite a few dealers who are interested in this trade, big size, right? And long dated actually option is not easy to handle, but I think a lot of people were able to handle. To me, some people were not able to enter this trade, not because they could not handle the equity risk, it's they could not handle the CVA counterparty risk. Okay, first of all, we know there's a CVA, right? Essentially we bought option from Warren Buffett, right? Eventually he may need to pay, and at that time he may default, right? So that's a regular CVA risk. But there's also a wrong way risk, meaning a more severe risk, right? You can imagine, right? When the market, sells off, right? Warren Buffett would actually owe us more money, right? Do you think in that scenario he will be more likely to default or less likely to default? Right? He will be more likely to default. That's where the term wrong way risk comes in. When your counterparty owes you more and more money, that's when he is more and more likely to default. Right? That's even harder to actually model. And there's a liquidity funding risk, which can also be wrong way, right? Because as a dealer, you may need to come up with $1 billion or $2 billion, cash and to pay Berkshire, right? Where do you get the money from, right? Typically, people need to issue a debt, right, to fund in a senior unsecured way, and essentially you pay the credit spread on your debt, and that is essentially the cost of your liquidity or funding. So what we did was essentially charged, Warren Buffett CVA and wrong way CVA, charged the funding cost, some wrong way funding cost. Another challenge, of course, is that some dealers, I suspect, they could price CVA, but they do not have a good CVA trading desk risk management to do the risk management of CVA and funding, right? Once you have, this position at hand, right, you have, counterparty risk, right? How do you hedge it, right? You charge Warren Buffett X, $1 million for the CVA. If you don't do anything, when their spread widens, you're going to have a lot more CVA loss, right? So you need to, risk manage that, right? Of course, you can do dynamic hedge, right? But dynamic hedge, if we drill down to details, it requires a fair amount of, you suffer a fair amount of gap risk, right? It's not like a bond, right? If you own a bond, you can buy, a CDS protection on the same bond. More or less, you are hedged for a while, in a static way. But for CVA, it's not. The reason for that is the exposure can change over time. One thing, we tried at the time, essentially, we sort of structured a credit-linked note type of trades, right? Essentially, you go to people who own or would like to buy, Berkshire's bond, essentially to tell them, okay, we have a credit asset similar to, Berkshire's bond. If you feel comfortable with owning Berkshire's bond, you may consider, our asset, which pays, more coupon. And the reason we were able to pay more coupon is we were able to charge, Berkshire a lot of money. And there's also a trunk portfolio protection thing not involved, but I'm gonna skip that for the sake of time. But then the question is, right? We charge a lot of money from Berkshire. Why would they want to do this trade, right? What they think, right? So here's my guess, right? As you know, they have an insurance business, and then they wanted to explore other ways to sell insurance. So selling puts essentially is selling insurance on the equity market, and they sold like 10, 15 year maturity puts, right, at below then spot. So then people can think, okay, what's the likelihood of a stock price coming down to below the current spot in 10, 15 years? Well, it happened, but it's not very likely. And they do have, a day one cash inflow. So essentially, one way Berkshire was thinking is that they got low funding costs, right? If you read Warren Buffett's paper, essentially he thinks it's like 1% interest rate on like a 10-year, cash, something like that, right? And it's very important they manage their liquidity well, right? And they will not have any cash flow until the trade matures. Okay, so that's how they avoided, the cash flow drain during 2008, right? Even though they did suffer unrealized mark-to-market loss. But what's interesting is that during 2008, 2009, Berkshire did explore the feasibility of posting collateral. Okay, they started with no collateral posting, but then they wanted to post collateral. They actually approached some of the dealers saying, "Oh, I want to post some collateral." Why is that? Right? There's no free lunch, right? So what happened was, they were smart not to post collateral, but during crisis, right, their spread widened. Everyone's spread widened, right? So Berkshire spread widened, and Warren Buffett owed more money. So guess what? The CVA hedging would require the dealer to buy more and more protection on Berkshire. When you buy more and more protection on someone, that would actually drive that person's, that entity's credit spread even wider. So Berkshire essentially saw their credit spread widening a lot more than they had hoped for, than they had anticipated. And later on, they found out it was due to CVA hedging, CVA risk management. Okay, so and that actually affected their bond issuance. When you have high credit spread from CDS market, essentially the cash market may actually may actually follow, right? And whoever would like to buy Berkshire's bond would think twice. Okay, if I have to buy this bond, if I ever have to buy, credit protection, it's going to cost me a lot more now because of the spread widening. So therefore, I'm going to demand higher coupon on Berkshire's bond, and that drives their funding costs high. So they explored different ways to solve the problem, right? Now, another thing, of course, is very interesting to ask, right? Berkshire, thinks they are making money, and the dealer thinks they are making money, which is probably true, right? But then the question is, who, is losing money, or who will lose money? Anyone has any ideas? I think there's probably a lot of answers to this, right? My view is that essentially whoever need to hedge, whoever need to, buy put, right? And if the market doesn't, decline as much as you hope for, essentially you'll pay for a put premium and did not get, the benefit. Okay, here's an interesting CVA conundrum. Now, hopefully by this time, you guys fully appreciate, the CVA risk and the impact of CVA, right? In terms of risk itself, in terms of magnitude, right? As I mentioned earlier, during the crisis, 2008 crisis, it was a huge amount, easily billions of dollars loss for some of the firms due to CVA, and that's more than actually the actual default loss, right? Now, given the CVA, right? So if you trade with counterparty A, naturally you will say you want to think, okay, I want to buy protection, right, to hedge my CVA risk. So you buy credit protection on A from counterparty B. But again, right, if you trade with counterparty B, you would have CVA against counterparty B, right? You would have a credit risk against counterparty B. So what are you going to do, right? If you just, follow the, a simple thinking, essentially you may think, oh, okay, maybe I should buy, credit protection on B from counterparty C, right? But if you were to do that, then you have to continue on this. It becomes an infinite series, right? Infinite series, okay, I would say theoretically, but in practice, I feel it's going to be very challenging to handle, right? So what will be a simple strategy to actually terminate this infinite series quickly, right? Right. So, yeah, this also has theoretical implication for CVA pricing, right? Sometimes we say, okay, arbitrage pricing is really replication. Use hedge instruments. Now you have to use infinite number of hedge instruments, right? Well, that's going to impact your replication, right? Modeling, right? So the way people do, right, practically is to buy credit protection on A from counterparty B, fully collateralized, typically from dealer. Okay, so however much money you owe from counterparty B, right away they're going to post collateral. In a way, it's more or less similar to future contract, settling, and that minimizes the counterparty risk. So you can cut off this infinite series easily. So here, I like to touch upon on what I call enterprise level derivatives modeling. We mentioned trade level derivative models. That essentially is just regular model, right? I mean, when people talk about derivative models, essentially people talk about trade level models. Essentially, your model each trade independently, right? Your model is price, mark-to-market, or it's Greeks or sensitivity. And then when you have a portfolio of these trades, essentially you can just aggregate their PV, their Greeks, right, through linear aggregation. And then essentially you get the PV of the portfolio. Okay? But as we have seen already, that doesn't capture the complete picture. There are additional risks that require further modeling, right? One is nonlinear portfolio risks, right? So essentially, these risks cannot be like a linear aggregation of the risks of each of the component trade in the portfolio, right? Example we have gone through is CVA. Funding is of similar nature. Capital liquidity are also examples, right? And the key to handle this situation is to be able to model all the trades in the market and the market risk factors of a portfolio consistently, so that you can handle the offsetting trades, properly. Okay. Of course, we need to leverage the trade level model essentially to price, each individual trade as of today, as of a future date. Right. What's interesting is that there's also feedback, to the trade level models, right? For instance, we price a cancelable swap, okay, as a very popular trade. Now, this cancelable swap, right, we trade with a counterparty. Let's say, assume it's anti-analyze. We trade with a counterparty. That's close to default, right? The trade level model doesn't know about this counterparty, about default. The trade level will give you independent, the exercise boundary, when do you need to cancel the swap, independent of the counterparty credit quality, right? That invites a question, right? When the counterparty is close to default, even if your model says, okay, you should not exercise, based on the market condition, but shouldn't we consider the counterparty condition, credit condition, right? If the counterparty were close to default, if you cancel your swap sooner, essentially you eliminate or reduce the counterparty risk, right? This is actually interesting, application and feedback between, trade level models and the, enterprise level models, right? So what we did was, in some of my previous jobs, what we did was we actually figured out, okay, the counterparty risk in these trades, major trades, right? And then essentially we just tell the underlying trader, okay, if you were to cancel this trade, we have a benefit for you because we're gonna reduce the CVA, right? Or even zero out CVA. So the CVA trader would be able to pay the underlying trader. So therefore, the underlying model actually can take this as an input, right? Rather than, as part of the exercise condition modeling, right? Knowing if you cancel earlier, you potentially can get additional benefits, right? This model may tell you, right, to handle the risks more properly. Market risks together with counterparty risks, right? I mean, this is roughly, the scope and the application of the enterprise level model. This is actually a fairly significant, modeling efforts, as well as, significant infrastructure and data efforts, right? And essentially, it requires a fair amount of, Martingale testing, Martingale reasoning, Martingale interpolation, and Martingale modeling. Right. The reason for that is when you have, a trade model, okay, and each trade model can model a particular trade, accurately, okay, and there's certain, market modeling, simulation of the underlying market or, great PDE, right? But when you put, a portfolio of trades together, right, the methodology you use for modeling one trade accurately may not necessarily be the methodology you need to model other trades accurately, right? Some will require PDE, some will require simulation, but you need to put them together, right? Typically, we use simulation, and that introduces numerical inaccuracies. And the Martingale testing would tell us, okay, are we introduce a lot of errors? Martingale resampling essentially would allow us to correct the errors. As you know, the Martingale is like a foundation of the arbitrage, pricing, right? Essentially, Martingale resampling will actually be able to enforce the Martingale conditions in the numerical procedure, not only theoretically, right? Martingale interpolation, modeling are other important, interesting aspects. If we have time, we can that. This systematic approach. There are, different approaches, but how to do it in a systematic way still remains additional work. Right. So I'd like to quickly go over some of the example of Martingale and Martingale measure. Right. I may need to go through this, quite quickly due to, the time limitation. But hopefully you guys have learned all these already. Right. This is hopefully more like a review for you guys. Right. So essentially, we are talking about a few examples. Right. What's the Martingale measure for forward price, for LIBOR, for swap rate, for the FX rate, for the CDS par coupon? I would hope you guys would know, the first few already. The forward CDS par coupon, in my view, is actually fairly challenging. For simplicity, I'm not considering the collateral discounting explicitly, right? That, as additional challenges, but still we can address that, right? So under the risk neutral measure, right? Essentially, for this, Y of P being the price of a traded asset with no intermediate cash flow, right? Essentially, this Y, P over beta P is a Martingale, right? I mean, this is essentially the Harrison-Fiske Martingale no arbitrage theorem, right? Essentially says, right, for two traded assets with no intermediate cash flows, satisfying, certain technical conditions, the ratio is a Martingale. And there's a probability measure corresponding to the numeric axis. Okay. Therefore, naturally we have this conclusion, right? The forward arbitrage-free measure essentially corresponding to a numeraire of zero coupon bond, right? Naturally, we can find, this Y of P and the P-PT ratio is a Martingale, right? Again, it's just a ratio of two traded assets with no intermediate cash flows, right? And, from the definition of the forward price, right, essentially the forward price is, a Martingale under the forward measure, right? Forward LIBOR, right? This is the forward LIBOR. Essentially, it's a ratio of two zero coupon bonds. So naturally, we know it's a Martingale under the numeric axis, right? So essentially, it's a forward measure up to the payment of the forward LIBOR. Okay, so this is the Martingale condition, right? Similarly, we can do this, argument on the forward swap rate, right? Essentially, a forward swap rate is, we can start with like a annuity, right? Numeraire, right? And since the forward swap rate, essentially we know is the difference of 2 zero-coupon bonds divided by annuity, right? And therefore we can conclude, based on Harrison-Pliska theorem, this forward swap rate essentially is the Martingale under the annuity measure, with this annuity as the numeraire. The same argument goes, for the forward FX rate. I mean, the idea, or the pattern you probably have seen is for any quantity, right? You see if you can find two assets, and then use these two asset ratio, right, to represent this quantity. So the forward FX rate essentially, is a ratio like this, right? This is nothing more than the interest rate parity, right? From the spot, right? You grow both, right? You start with spot, you grow the domestic currency, and then you grow the foreign currency, right? You get FX forward, right? And the FX forward is a Martingale measure under the domestic forward measure, right? And this is a simple technique to do the change of a probability measure. It's roughly how I, remember, change of a probability measure and the read on Newton derivative, right? You essentially start with, again, Martingale, right? Assuming, this is Martingale, right? And under a particular measure corresponding to the numeraire asset, right? And then this quantity is also a Martingale under a different measure corresponding to a different numeraire asset, right? One key point is when you change, probability measure, essentially you change the numeraire corresponding to the probability measure, right? And therefore, essentially, important thing is, right, we know the PV or, the mark-to-market of a traded security is measured independent, right? Doesn't matter, what mathematics you use, right? If it's a traded security, it's gonna, match the market price. And therefore, you can price this security and one measure or one numeraire, and then you can price it again with another measure, another numeraire, and they got to be the same, right? Then naturally you see, this is a simple equation at the starting point to do the change of measure, right? If you just simply change a variable, right, then essentially you get your change of measure as well as, written nicotine derivative. If you worked on the BGM model, you probably recognize this, change of measure, right, which is used for BGM model under the forward measure, right? Now here's the subtlety, right? Credit derivatives, right? Naturally, people would think, okay, since the forward swap rate is a Martingale under the annuity method, right? Naturally, people would think, okay, then the forward, CDS par rate, right? It's like a forward swap rate. Got to be a Martingale under the risky annuity measure. Okay, so that's quite intuitive, except there's one problem, right? If the reference credit entity has zero recovery upon default, then this risky annuity could have a zero. And now we are talking about we want to use something that can be zero as our numeraire, right? How do we resolve this technical mathematical problem, right? So that's actually very interesting. Well, Schumacher was the first person who published a paper on this one. Okay. I was trying to do some work myself when I was working on BGM model. I thought wouldn't be nice to extend the BGM model, right, to the credit derivatives. Right? But then immediately, I stumble with this difficulty where when the recovery is 0, you can have a 0 in your numeraire, in your risky annuity. Right? So Schumacher, right, essentially his idea was, let's focus on survival measures. Meaning we have a difficulty, if a default happens and the recovery is 0. Now his idea is let's forget about that state. Okay, let's not worry about that. Okay. Okay, but one immediate question people will ask, if that's the case, right, the probability measure, okay, physical probability measure or risk neutral probability measure and this survival probability measure are not equivalent, right? Because the survival probability measure knows nothing about the default event. Okay, so they are not equivalent, right? So that's essentially you actually, transform one mathematical difficulty to another one. Luckily, the second one it turns out to be actually easier to solve, right? So the starting point is again using Harrison-Pliska theorem. Essentially, you just need to identify like numeraire asset and the denominator asset, right? You identify two assets, you make a ratio, and then right, okay, those are a Martingale, right? So essentially, this is a forward swap rate and forward annuity, and right, and if we have this indicator of the default time of J's credit name greater than this T, essentially this is like the premium leg of CDS. Okay, and that's a traded asset. So therefore, we have Martingale like this, right? The subtlety, as you probably can envision, is gonna come in when we do the change of property measure, right? Okay, so we have talked about, right? How are we gonna find the Martingale measure of CDS par coupon or forward CDS par rate, right? This is a starting point of Martingale model, right? Essentially, for any quantity you want to model, you try to find its Martingale measure, right? And once you find its Martingale measure, you can do a Martingale representation, right? And then oftentimes you need to do change of a property measure, so that all the term structure, for instance, a consequence of variables are modeled in a consistent property measure, right? So finding the Martingale measure is the first point, right? So survival property measure, right? Essentially, he just defined this way. You can define this Reed-Nikodym derivatives, okay? And then once you define that, essentially, if you remember the previous, formula, I mean, essentially, you will have a Martingale condition like this, right? Details, right? It is the property measures are not equivalent anymore, but yet you can still do change of property measure, and you need to separately model, what's going to happen when the default happens if you want to use this model, right? Now I like to move, to the second part, Martingale. Well, I mean, Martingale testing, Martingale resampling, and interpolation, right? Martingale testing essentially given the previous Martingale conditions, right? I mean, those are, by the way, just examples. There are a lot more, right? Essentially, that's what it should be theoretically. You just test in your numerical implementation and see if those conditions are satisfied. Okay, that's Martingale testing. Martingale resampling is we know most likely if we were to test, we're going to fail. Okay, this is not necessary for enterprise level models, but even for trade level derivative models. A lot of times I've seen the Martingale conditions are not exactly satisfied, right? So one way to do that is to correct that, right? Correct, this error. And the rationale is essentially because of a numerical, right, approximations. Whatever quantity we model, essentially is not a true quantity. And the true quantity we model essentially is some function of what we, have in our model. So therefore, you specify a certain function. Sometimes you can have a linear, non-linear function. And, this, x naught is what we have in our model. And then this x is what we need, okay, to satisfy, the Martingale condition, right? So essentially, what in this particular case is very simple. First of all, you demean, and then you adjust the deviation. So therefore, given any quantity x naught, you can have it, you can force it to be any given mean. And this mean, in our case, will be determined by the Martingale condition. Okay. The next, interesting thing is Martingale interpolation. Oh, I had a typo here, right? Essentially, sometimes you have like an intermediate model, for instance, you model LIBOR, and your LIBOR you can have a different tenors, right? When you have a yield curve, at any given time there's a term structure. So in the model, a lot of times we can model a few selected points. But what if your model requires a term structure, a term that's not in your model? So what people normally do is you do Martingale, you do interpolation. Okay, so you have a 1-year LIBOR, like a 5-year LIBOR, and then you need 3 years. What do? You interpolate, for instance, right? But interpolation doesn't automatically guarantee Martingale relationships, right? So Martingale interpolation has a goal of automatically satisfy the Martingale relationships. So we're a particular way of interpreting. Actually, it turns out to be so simple. If I show you guys, you go to the right side, so simple. The starting point is this Martingale, condition that I wrote down on the slide. Essentially, this S and T are the, calendar time, and this capital T is really like a term structure. Okay, you have a 1-year rate, 2-year rate, 5-year interest rate, right? Those term structure, right? And how do we interpolate such that after interpolation, the corresponding Martingale relationships are satisfied? So here's what we do. Okay, so we start with let's say capital T1. Okay, so capital T1. That's a point that we model, and we assume that one is properly Martingale resampled and satisfies the Martingale condition. And this is a Martingale, right, for term T capital 2, and that is also satisfies the corresponding Martingale condition. And our goal is to figure out okay, T3. How do you do interpolation so for the term T, capital T3, such that this capital T3 will satisfy its own corresponding Martingale condition, right? If you do simply linear interpolation, using T as, capital T as independent variable, right? Essentially, you're not going to achieve that, right? So the key is we need to choose the proper independent variable for the interpolation. Essentially, is the previous time or time zero quantity. Okay, so time s is before time t. We can imagine time s will be 0. Okay, so using the corresponding quantity at time 0 as independent variable, then essentially you can achieve that. Okay, so it's still linear interpolation, just to use a different independent variable, right? Essentially, you can show that very easily. This is just simple algebra, right? If you take expectation, right, this one being Martingale, this little t will become s, right? And then if you do expectation here, the little t will become little s. And therefore, if you combine these two, a lot of terms would actually, cancel, and essentially you will be left with this Martingale at time s and t, capital T3, meaning this is the Martingale target of this particular term. And that turns out to be the expectation of this quantity. So it's a very simple linear, simple algebra, right? You guys can, check if you want. So this one essentially guarantees the interpolated quantity automatically satisfy, the condition. Martingale target. Of course, you need to know the Martingale target, right? If you don't know, that's a different story. Then you need to do something else. Typically, time 0, for instance, is what the market can tell us, right? And of course, sometimes you need to make some assumptions. But whatever assumption on time 0 you make in your dynamic model, right, you automatically satisfy the needed Martingale condition. This is just a brief introduction of how we do the Martingale modeling. Okay, so this LIBOR market model, as you guys probably have learned already, right? There's different forms, a BGM as the initial form, and then Jamshedian, right, came with another form, right? And but in terms of a general Martingale modeling, what we'll do typically is we start to find the Martingale quantity. Okay, and we know a forward LIBOR is a Martingale and its own forward measure. Okay, and then we know, we can use Martingale representation. So under certain technical conditions, right, this diffusion process can be represented by a Brownian motion. Okay, and then we can assume log normal, just for example. We don't have to. We can use CVA, we can use stochastic volatility, right? But the starting point is Martingale, identifying the Martingale measure, and then perform Martingale representation. So essentially you get this, stochastic differential equation. Then you need to change, measure or change numeric, right? Because this one essentially says for a particular LIBOR, you have a Brownian motion and a different measure, right? So that has a limited usage, right? A lot of the derivative trades, IR trades, essentially it's sensitive to the entire, yield curve. So you need to make sure you model the entire yield curve consistently. So therefore, you have to change the probability measure so that everything is specified in the same common measure, right? And you know, and of course you can have a choice which one you want to use as a common measure. Right? Through simple, you know, change of numeraire, I mean, essentially we can get stochastic equation like this, and then, you know, we have a Brownian motion. Right, we have a Brownian motion with a correlation, you know, like this. Right. So this is essentially a market model in a general form, right? With full dimensionality, meaning one Brownian motion per term of a libel. So that's the full dimensionality. And then you need to do hi.
Can you wrap up, because we need a bit of time for questions.
You need to extend. Sorry, I can actually wrap up now, right? If you want to.
Sure. Okay. Any conclusions?
Well, okay. You know, the conclusion is the following thing, right? You know, there is a need for enterprise level models to handle nonlinear portfolio effects. And we need to leverage, you know, tree-level models. And by doing so, we need to, you know, employ Martingale testing, Martingale resampling, interpolation. And not only we need that for CVA, but we also need that for funding, liquidity, capital risks, which are very critical risks. And people have started paying more and more attention to these risks, especially since after the crisis, right? Because of time limitation, I'm not going to be able to finish another example, but if you like, you can take a look, you know, page 22, you know, of the slides. Hopefully, so you can circulate it. All right, thank you, guys.
Yeah, thank you. So yeah, the slides, we'll publish the slides probably later tonight. So please take a look.
Okay.
So to wrap up, let me see. I wanted to bring up.
That's okay. Probably, if it's a course website, that's fine.
Yeah. I did add a few topics which were used last year for final paper for your interest in the document which is on the website. So take a look. Basically, yeah, the themes there were mostly Black-Scholes or more advanced models or manipulation Black-Scholes equation. There was a very interesting work on statistical analysis of commodity data. So if somebody is up for it, that would be very interesting. And there were a few numerical and Monte Carlo projects. So any questions?
Yeah, so actually we was planning to give you a bit more time to ask questions, but since we have 5 minutes, I think maybe I'd like to ask you to just think about what we learned this term, right? So, and Peter can add on what do we think on the mathematics and also both applications. And in conjunction, while you're doing the final paper, just focusing on the new things you think you learned and what you like to explore in the next stage of your research. So I think probably we don't have a lot of time for lots of questions, but if you have any questions, this will be a good opportunity to ask about the paper or the course. Peter, you want to make some comments?
Sure. I'd just like to say that I think this course was a very challenging course for most of you, and that was, I guess, our intention, and I really respect all the hard work and effort that everyone put into the class. And in terms of the final paper, we will be looking at your background and look for insights that demonstrate what you've learned in the course. And I've already reviewed several papers, and I'm very pleased with the results. So I think everyone's done a great job. This course, I think is intended to provide you with the foundations of the math for the financial applications, as well as an excellent introduction and exposure to those applications. And I think you'll find this course valuable over the course of your careers, and look forward to, contributing, insights, with questions you might have following the course. I'm sure the other faculty feel the same way. We want to be a good resource for you now and afterwards.
Very, very well put. So please feel free to contact us, and please stay in touch. All the contact details are on the website. We plan to have repeat of this class next year, so please tell your friends or stop by next year, which will be next fall. It will not be exactly the same. We will try to make it slightly different, but it will be close.
Well, if you have any suggested topics you feel you haven't been exposed to or like to know more, send us emails. We can. I think one of the value of this class is we can bring in pretty much everyone from the frontier of this industry to give you some insights of what's going on.
Please take a review on the website. This is important. And that's about it.
Okay. Well, thank you for your participation.
And thank you, IT. It was a pleasure.